If you're just starting out, investing can feel confusing, risky, and honestly, a little scary. Most beginners rush straight into buying stocks, crypto, or whatever's trending, and that's why so many people lose money in their first year. But here's the truth. Successful investing isn't about picking the next hot stock. It's about building the right foundation first. In this video, I'll walk you through everything you need to do before investing, and then show you exactly how to start investing step by step. By the end, you'll have a clear, beginner-friendly roadmap that can set you up for long-term wealth. Step 1. Build the right money foundation first. Before you put a single dollar into the stock market or any investment, you need to build a solid financial foundation. Think of it like building a house. If the base isn't strong, everything on top can collapse. Step 1 is an emergency fund. This is money set aside for unexpected expenses, like medical bills, car repairs, or even job loss. A good rule of thumb is to save at least 3 to 6 months of living expenses. That way, if life throws you a curveball, you won't be forced to pull money out of your investments at the wrong time. Step 2 is tackling high-interest debt. If you're paying 20% interest on credit cards, but your investments might only make 8 to 10% per year, you're losing money by trying to invest before paying off that debt. So clear those first. And step 3 is having a budget. This doesn't mean tracking every penny, but knowing how much you earn, spend, and save each month. The goal is to create a gap, money left over after expenses, that can consistently go toward investing. If you skip these steps, investing can feel stressful and risky. But if you build this foundation first, investing becomes exciting because you know your financial safety net is already in place. Step 2. Understanding your money goals. Once you have your financial foundation in place, the next step is to get clear on your goals. Because the truth is, there's no such thing as a one-size-fits-all investment. The best investment for you depends on what you're working toward. Start by asking yourself, what am I investing for? If it's something short-term, like buying a car in 2 years or saving for a vacation, then you don't want to put that money into risky investments like stocks. Instead, keep it in safer places like a high-yield savings account or fixed deposits. But if your goals are long-term, like buying a house in 10 years, building wealth for retirement, or funding your child's education, then you can take on more risk because time is on your side. Your goals also affect how much you need to invest. For example, investing 5,000 rupees a month for 20 years could grow into a huge retirement fund, while the same amount over 2 years might only cover a small short-term goal. So before you even think about where to put your money, write down your financial goals clearly. This will guide every investment decision you make. Without a goal, you're just throwing money into random places. And that's not investing, that's gambling. Step 3. Learn the basics of investing. Now that you know your goals, let's understand the basics of investing. Because without this foundation, it's easy to get lost in all the noise. First, remember this. Saving and investing are not the same. Saving is about keeping your money safe and liquid, like in a bank account. Investing is about putting your money to work so it grows over time, even if it means taking some risk. So, what can you actually invest in? These are called asset classes, stocks or shares. You own a piece of a company, and your money grows if the company does well. High potential returns, but also higher risk. Bonds. You're basically lending money to governments or companies. Lower risk, lower reward. Mutual funds and ETFs. These are baskets of stocks and bonds managed for you. They're great for beginners because they spread out the risk. Real estate. Buying property for rental income or long-term growth. And then there are alternative investments like gold or crypto, which can be part of a diversified portfolio, but shouldn't be your first step. Here's the golden rule. Every investment has a balance between risk and reward. The higher the potential return, the more risk you're taking. Beginners often chase high returns without understanding the risk, and that's when they lose money. So, before you invest, get comfortable with these basics. Once you know what each option means, You can pick the ones that fit your goals and your comfort level. Step 4. Choosing the right investment strategy. At this point, you know your goals and the basics of investing. But here's the big question. How should you actually invest your money? This is where strategy comes in. There are two main approaches. Active investing, where you pick individual stocks, time the market, and try to beat the average returns. This can work, but it's risky, time-consuming, and even professional investors often fail to do it consistently. Passive investing, where you invest in the entire market through index funds or ETFs. Instead of betting on one company, you own a small piece of hundreds of companies. This spreads your risk and lets your money grow steadily over time. For beginners, passive investing is usually the smartest choice. Why? Because it takes away the guesswork, costs less in fees, and historically, index funds have beaten most active investors over the long run. The key idea here is compounding. When you stay invested for years, your money doesn't just grow, it grows on top of its own growth. That's why the earlier you start, the more powerful your results will be. So don't stress about finding the perfect stock. Instead, choose a simple, long-term strategy that matches your goals and let compounding do the heavy lifting. Step 5. Getting started practically. All right, now let's bring everything together and talk about how you can actually start investing. Step 1. Open an investment account. Depending on where you live, this could be a brokerage account, a demat account, or even an app that allows you to buy index funds or ETFs. The process is simple. You sign up, verify your details, and link your bank account. Step 2. Decide how much to start with. Don't wait until you have a huge amount of money. Even small amounts, 500 rupees, 1,000 rupees, or $50 a month, can grow massively over time thanks to compounding. The most important thing is consistency, not the starting amount. Step 3. Use a strategy like SIP, Systematic Investment Plan, in India or dollar cost averaging elsewhere. This simply means investing a fixed amount every month, no matter what the market is doing. It removes emotions like fear and FOMO and ensures you're buying both when prices are high and when they're low. And finally, avoid the common beginner mistakes, chasing hot tips, investing in things you don't understand, or trying to get rich overnight. Successful investing is about patience and discipline. Remember, the best time to start was yesterday. The next best time? Today. So let's quickly recap. Before investing, build your foundation, emergency fund, pay off high-interest debt, and stick to a budget. Then, set clear goals so you know what you're working toward. Learn the basics of different investments, choose a strategy that fits your goals, ideally something simple and long-term like index funds. And finally, start small but stay consistent. If you follow this roadmap, you'll avoid the common beginner mistakes and set yourself up for long-term financial success. Remember, investing isn't about timing the market. It's about time in the market. The earlier you start, the more powerful compounding becomes. If this video helped you, make sure to like it, subscribe, and let me know in the comments. What's your very first investing goal? I'd love to hear your plans.